Okay, the webinar has started and participants are filing in. That's great. We'll just give them another couple of minutes. And in the meantime, I guess I'll introduce myself to the people there. I'm Paul Barreca, uh, financial advisor at West End Wealth Planning. And I'm here, our very special guest, Guerlane, and I believe I got that pronounced correctly, Guerlane Noël, who's the Assistant Vice President of Tax and Estate Planning at Mackenzie Investment. And Guerlane has kindly offered her time in the evening to come and go through this, what I think is a pretty darn important topic for people, and year-end tax planning strategies. And just to let people know, of course, today we're going to talk about year-end tax planning strategies for individual investors. We're going to talk about for families. We're going to talk about for corporations, as well as tax reporting considerations. And what I'm going to do too, we're also going to spend some time on the big changes in the capital gains inclusion rate this year. Wow, a 33% increase in tax on capital gains for individuals who declare more than $250,000 of taxable gain in 1 year. And if you have a corporation and passive income, it's from $1. So, and that creates some interesting thing, Guerlane, where we'll talk about a little bit later, some strategies that people now should be considering to kind of deflect those significantly higher tax rates on capital gains. And by the way, Guerlaine, the way I look at this, it's great to look at year-end tax planning ideas, but tax planning is something that should be an ongoing process that happens yearly. I mean, that's how the wealthy people do their planning, right, Guerlaine? They plan not just for this year, they plan for next year, the next decade, and the next generation. Right? I mean, you have a fair bit of experience. That's how a lot the wealthy people do their planning, not just in an isolated area. So,
Absolutely. And I like to say that those who will benefit the most from the tax system are those that constantly think about tax throughout all the year,
yes,
right?
yes.
From January to December.
And by the way, just some interesting statistics. The Fraser Institute tells us, and anyone who's listened to me before, I've talked about this statistic for so long. The average family and the median family income, and I'm looking at my other screen here in Canada, is $84,000 family income median in Canada. They pay about 43% of every nickel that they bring in some form of taxes, income taxes, sales taxes, gas tax, whatever. Now, that's just for the median income. So if your family has a median income above that, your rate goes up significantly. Now, why is that important? That is more, that 43% is more statistically than what people pay for clothing, shelter, and food combined.
Mm.
So this is and you know what I find, Guerlaine? I think Canadians, we're also nice. I think we just put up with this. The amount of people that we talk to who focus, for example, when they're looking at their portfolio, the pre-tax return is more important than the after-tax return. And the only line I like to be quoted by is that the only important dollar is an after-tax dollar. So,
Absolutely.
and just for fun, got some statistics here. We talked about it, Guerlaine, a little bit before, and I'm going to compare a couple of statistics for Canada and the US. Now, in Canada, I'm just looking at my screen over here. The top tax bracket starts with an income of $246,752 in 2024. I happen to be looking in the Wall Street Journal today, and they have their tax brackets for 2025. The top tax bracket in the US starts at $626,351. That's more than double where it starts in Canada. And we mentioned too, the capital gains rate in the US, as an individual, you can earn over $48,000 of capital gains tax-free. If you're a family, you can earn the first 96,000 and change completely tax-free. So I just said that would be kind of funny to to compare. So why don't we get started with the presentation now? And again, I hope this is going to work. Let's see. Yeah, yes. Okay. So our agenda today, and this is Guerlane's agenda, again, individual investors, families, corporations, tax reporting considerations. And we're going to try to leave some time for Q&A at the end. Anyone who has a question, you're going to see at the bottom of the screen a Q&A screen. Please be feel to ask the question. We may decide to answer it, time considerations, during the presentation, or we're going to try and leave some time at the end. So please feel free to leave whatever questions you may have on the in the Q&A box. So let's get started here, and we're going to start on capital loss planning. And Guerlane, you got some examples, I think, to run through, Guerlane. And I think what people often don't think about here is the carry back and the carry forward rules in this. Well, why don't I leave this up to you, and you can let me know when you want us to change the slide here. But I'll give this over to you now.
Thank you. Thank you so much, Paul. So I hope everyone is doing well. So let's start with that great topic. So I don't think anybody here likes to realize a loss, but from my with my tax hat, I always like to present capital losses as a good thing from a tax perspective. Why a good thing? Despite the fact that, yes, we don't want to lose money, capital losses are applicable to erase, let's phrase it like that, to erase our taxable capital gains, right? If you realize a capital loss, you will be able to use that loss and apply it against a taxable capital gain, either of the current year, but like Paul just mentioned, you can always, and that's the big advantage, you can always carry it back to one of the three previous years, or indefinitely in the future. Because capital losses can only be used to erase or reduce your taxable capital gains, the law is well made in a way where in the future, you don't have any years in terms of limit, in terms of when or up to what point you're going to be able to use those capital losses. So it's a good thing. Now, there are some what we call in our jargon, if you want, some tax restriction in terms of how you could use your capital losses. Why? Because the government, the law doesn't want you to artificially create some losses just so that you could actually reduce your taxes. And when I'm saying reduce your taxes, ultimately, because you understand right now that capital losses can only be applicable to taxable capital gains, that's what you're aiming for. So here, it brings us to the topic of what we call a superficial loss. So in a great fashion, a superficial loss is when some individual realizes a capital loss, and within a period, and that's important, that will comprise the day of the sale of a certain asset, 30 days before and 30 days after, which you would have understand that it gives you a period of 61 days. Either the person, him or herself, or their spouse would purchase either the same asset or an identical property. Okay, so if that happens,
we just stop there. When you say identical property, you're talking about real estate there, Guerlane?
It could be shares. It could be anything.
Shares.
We're talking about assets. Yes, it could be a land. It could be shares. Any assets, basically. Yes,
Okay.
real estate, but not only real estates.
So obviously, if real estate, you can't buy the unless you buy the identical property right back. I don't think that's going to help. But just as a matter of note, there, of course, the markets have done so well with portfolios. Very few clients are going to have capital losses this year, but they can go back, and if their advisor has been creating those losses, say in 2022, I know we went back to a lot of our clients and crystallized losses. Hey, they're going to have gains this year probably. They can go back and say, hey, we created these losses back 2 years ago, 3 years ago, and let's use them now to reduce taxes this year. So let's talk about a little bit more on that superficial loss, and let me know when you want to go to the next slide here, Guerlane.
Sure, no problem. So, so that everybody understands. So if your loss is characterized or qualified as a superficial loss because either yourself or your spouse have purchased back that same or identical property if you want, then what happens is that your loss is refused right? The law will make you not be able to claim your capital loss, but the capital loss is added to the ACB, so the adjusted cost base of that new property or same property that you have repurchased.
Yeah.
We can go to the next slide, Paul. So
now I just want to clarify something. This does not apply to minor children, does it? If you have a child and you bought something in their name, it doesn't apply to them, does it?
that no, it doesn't, not to minor,
Okay.
right? Because there's a concept of what we call affiliated persons, as we can all see in the screen. So there are specific conditions that need to be met in order to be able to qualify a loss as a superficial loss and be tagged with that rule, right? With that restriction. So I spoke about the 61 days, which is really a key point. That's the period where if ever you decide to make such transaction, and Paul, in reality, most people that get hit by this rule, they actually don't know, right? They do all this planning, saying, okay, so I'm going to force a capital loss, just repurchase the property, or they do it between spouses thinking that it's going to work this way, but it doesn't, right? This is an anti-avoidance rule known so that people don't just, again, artificially create losses, because that's not what the law wants, right?
Now, this doesn't include if you have adult children. Let's say you have a 20-year-old child at home. Does that include them or not?
It could. Minor are not included, but no, with your children, if you actually make a transaction with them, and we're going to see this in a couple of slides, you would be safe. You would be safe.
Okay.
But
all right.
I always say, if you deal with your children, the fact that superficial losses rules are not applicable to them, there are other rules that will restrict the application sometimes of losses and even change your transaction. So maybe not this, but other things also. We could talk about that extensively, actually. Okay. So again, I think the best way to show how this rule is applicable would be to show an actual example. But just before we go to that example, Paul, people need to understand with who that rule could be applicable to. The easiest one is really with your spouse, right? But we often present that rule talking about the spouse, but if we actually look at the law, we talk about affiliated person, which is a concept in taxation that could be a little bit complex, but in its simple form, if you're common law partners, or if you're married, spouses, you will get hit by this rule, right? And furthermore, if you transact with yourself, that could be applicable to you. So you are considered to be affiliated to yourself, which is why if yourself...
I would imagine. So that's like if you're putting money into an RSP, right? You're affiliated. It sounds kind of humorous. So if you put money into, and now there's some nastiness in there too, because if you do that, explain how that can work against you by trying to do that.
Yes. So let's say that you do that big transaction with yourself. You sell, for example, a bunch of shares, and you purchase them the next 10 days, right? And then you're in that 61 days period. So let's see what would happen. Let's go to the next slide.
All right. Here we go.
And then let's go again to the next slide, and then we'll come back to this.
All right. Okay, there we go.
So let's look at the example. And if I'll let you know, Paul, to go back to the other slide. So we have Anne. She owns an investment fund. Let's call it Fund XYZ, with an ACB of 50K and a fair market value of 10K. So we could already see from this that there is a capital loss of $40,000. We agree right now, right?
Yes.
So husband Larry reported a capital gain of 40K in 2022. Let's transfer Anne's losses to Larry. Larry can carry his losses back to 2022, because let's all remind ourselves that I mentioned at the beginning that whenever you have a capital loss, if you cannot use it in the current year, you could use it in one of the 3 years back, or any given year in the future.
In the forward,
this is what we're trying to attempt here. Let's go back to the previous slide, please, Paul.
Okay. Oh. This one, right? Okay,
This
great.
one, yes. So one way to work around this hit rule of superficial losses, again, remember when it applies, you as the person who's selling your asset, you will not be able to claim your loss, or actually right away, but the loss, the denied loss, that's how we should refer to it, will be added to the ACB of that identical or same property that you just purchased. If we are doing the math, it only means that whenever you sell that other property, this is only at that time that yourself or maybe your spouse, let's say that your spouse was the person that has repurchased the same property, they will be able to claim the loss at this time. So we use superficial loss as a strategy also, especially for a couple. Whenever we have one spouse that has realized capital gains and we have one individual that will be hit by that superficial loss rule, we could actually force the superficial loss rule to be applicable to one individual in order to benefit the next spouse. So going back to the next slide, this is the example we're looking at when looking at Anne, right? So we all understood that Anne has a loss this year and that her husband has realized a capital gain in 2022. So there's
he's already, just to be clear, Larry, in this example, has already paid tax on this in 2022 yes. at whatever its marginal rate at. So by using this rule, and Larry will be able to go back and recoup that money that he paid 2 years ago. That's nice. That's very nice.
That's very nice. So let's see how the mechanic works. Let's go to the next slide, please, Paul.
Okay, there we go.
So step one. So for sure, Anne has to actually materialize that that capital loss, right? So she needs to sell XYZ investment fund. Like we saw with the numbers, she triggers a $40,000 capital loss. So this is step one. What happens in step two?
There we go.
So step two, Larry, the husband, he buys that XYZ investment fund for a fair market value of $10,000, which you'll understand totally makes sense. This was the fair market value at that same moment that Anne sold the fund. So he purchased it back at that amount, low amount.
Or within 30 days, right?
Yes,
or within 30 days.
Yes, and I will even say, Paul, all within that 61-day period, because people often think about 30 days after, but trust me, a lot of people do those transactions thinking we're going to maybe purchase the same shares, for example, maybe 10 days prior to sell, and then the actual spouse that will realize the loss purchase it on day one, and then the ticket will not be applicable, but it's not true. It's 30 days before, day of the sell, and 30 days after. So it's very important to mention this nuance.
Okay, so, next slide, next one.
Not yet. So Larry buys that XYZ investment fund for 10K. What happens? We have a superficial loss because we assume here that he does the transaction within those 61 days. So the superficial loss is applicable. And then that loss, that 40K loss, is denied to Anne. But like I mentioned, we take the loss and we add it to the ACB of the property, that same property purchased by Larry. So he purchased the fund for $10,000, and now his ACB will be increased by 40K, which will bring the ACB to $50,000. And then let's see what happens in step three. So Larry now will sell that fund for its fair market value, which is again $10,000. But because his ACB now reflects the denied loss of $40,000 of Anne, he now triggers a fair loss of $40,000 that will be able to be used against any capital gain. So let's go to the next slide. So just so that we all understand what happened here. Step one, Anne decided to sell her fund within that 30 days after, for the sake of this example. So Larry has sold, and you can advance to the next point, Paul. Perfect. So step two, Larry decided to buy back that same fund. And then within, again, that actually after the 30 days are done, and that's something very important, Larry sells the fund. Would you know, Paul, why? Let's say that after step 2, 10 days after, Larry would sell the fund. What would happen? Sell
Oh
the
my, I feel like I'm in a classroom here.
Yes, I chose you.
Well, if Larry sells a fund, then the superficial rules kick in, and I believe you said technically he buys $10,000, and but the carry forward the $40,000 loss, he's able to apply that, correct?
Yes, yes. The way the example is set up right now, it works well. But let's say that we're not careful and that Larry sells the fund to an affiliated person or himself. He purchased back again, he sells it, and then either him or his spouse purchase back again that same fund or an identical fund, then the rule would kick in again. Whereas if he goes out of that period of 30 days after and then he sells, unless he decides to sell to, again, his spouse, or his spouse buys back, again, the same fund, he's good to go. So the $40,000 realized in terms of loss, that was really Anne's capital loss, is fair to be used against any capital gain that he has. Let's go to the next step. So basically, just before we get to the next topic, based on the information we had, remember that in 2022, Larry had a $40,000 taxable capital gain that on which, like we mentioned, he had already paid taxes, right? We are in 2023. He realized a fair loss. And when I say a fair loss, just to say that it's a valid loss, he could actually amend his tax return and decide to claim that capital loss by doing a carry back to 2022. And like Paul mentioned, he will receive a great check for any taxes that he would have paid following the inclusion of that taxable capital gain.
Yeah, just wanted to mention here for those, excuse me, for any listeners, if you have questions, again, put them in the Q&A box. We may get to them during the presentation, depending on time, but we'll try to leave some time at the end to get to them. So the Q&A box. And should we spend maybe just a bit of time? Again, we got to be cognizant of time here. We got to get moving, but similar investment, not identical. For example, if someone owns, say, an index fund, they can buy a different index fund. Maybe they're both on the S&P 60 index, different company. It's a different product. It doesn't apply here. And that's the way people during that 30-day period, they can, if they want concerned about not being invested, they can buy something similar, but not the exact same product. They're going to stay invested. And then after the 31 days, go back to the original investment they sold.
That's a very good example. And in the investment world, another one example that we love to give is having, whenever you have a mutual fund company that has the corporate class and the trust fund, right? But they are identical fund because the structures are not the same. It's been accepted by CRA. These two products will not be considered identical properties. Same thing with ETF and having something in just a mutual fund. They will not be considered identical investments. So that's a way to work around it.
Okay, so let's just move down this list here again. We want to get going to some of the other issues here, but let's get going trying to quickly deal with this slide here, Guerlane.
Perfect. Perfect. So one thing you asked me at the beginning of this discussion about superficial loss, Paul, was do transfer to children would be applicable in terms when we are talking about superficial loss? And the answer is no. And that's also a way to work around this, where we always tell our clients, well, if you need to realize to force actually the materialization of a loss, do it with your child, right? Because
are you talking about minor children, Guerlane? Minor children or adult children?
Minor or adult children.
Minor or okay.
Yes, so that's a good thing to know. I was mentioning that with children, there's always things to consider. The law wants you to always deal at fair market value with your children. And if you don't, you get hit by those deemed, for example, proceeds of disposition that will have to represent fair market value. But normally, whenever you will transact with a child at a loss, it's not an issue. You will want to make the transaction occur at FMV. And the fact that there is an actual transfer of money or not, it doesn't change anything. It's going to force the transaction again to happen at fair market value. So the good thing with children, again, if you want to realize a loss, you will not get hit by superficial loss. Even if today you sell your XYZ investment fund and you buy it back just in 2 days, or your son or your daughter buys it back just in 2 days, it's okay. You will not get hit by this.
Yeah. Just another thing there, transfer to an RSP TFSA, not uncommon. People want to be careful there. If you transfer in kind into your RSP or TFSA or registered assets, if there's an unrealized gain, that will be taxable. But if you have an unrealized loss, you don't get credit for that. So never do that. You want to sell the asset, trigger the loss, and then put the cash into your RSP, TFSA, whatever.
That's a very good point, Paul. And people often learn about this too late.
After the fact. Yes, yes, I know. Okay.
After the fact. Yep.
Okay. So is that number 4? Can we go into point 5 now, Guerlane? The capital gains reserve. That might be something a little bit different for people. This often comes into play often when you sell a property, right? A piece of real estate, the capital gains reserve. Why don't we just briefly talk about that?
Sure, no problem. So whenever you have the opportunity, because let's be realistic, we don't always get to negotiate the terms of of our sale, but whenever you have the opportunity to spread the reception of the proceeds of your sale, it could be a good thing, or it will be a good thing, because it will give you, if you decide to opt for this option, you could decide to spread the realized capital gain over up to a maximum of 5 years.
5 years, yeah.
5 years.
No, we actually have a client in that situation now where they're selling their business, and they're taking a mortgage back for part of the sale for 5 years. So that's a perfect example. Well, then they can spread the tax over the 5-year period. So yes, there you go.
As long as you can agree with the purchaser to spread the sale and spread the proceed, because that's really what it is, it's good. And why 5 years? It's because the law wants you to recognize a minimum of 20% of your sale every year. And don't fall into the trap of thinking that you could spread your gain over 5 years, but for example, just get the proceed of your sale in 2 installments. Right? If you get more than that 20% a year, that's that percentage that you're gonna have to recognize in your income tax return.
So if someone gets a capital gain over 2 years, they can spread it over 2 years. Is that correct?
They could, exactly.
Okay,
but they couldn't say, since the law allows me to spread it over 5 years, I'm only going to recognize 20% a year. It doesn't work this way.
Okay. Why don't we get down to the next slide here and see what we have next here? Let's see. Some other things. First home savings account. Boy, when the government came out with this, I said, wow, you couldn't come up with a better tax structure.
Yeah.
Tax deduction up front, no tax going out, tax-free deferral. And what I'm sure you're going to get into this, we tell our clients, all of our clients who have adult children, say, let's get an account started. Even if you put $100 in it, now you've created the room for this year that you can carry forward. What tends to happen is that, people will say things like, oh, my son, daughter, they're not ready to buy right now. But that these things can happen quickly. They see that house or that condominium and they go, oh, that's the one we want. And they're signing on the dotted line. And oh my gosh, we didn't set up this first home savings account, cost them thousands and thousands of dollars of unneeded taxes. I'm sorry, I'm talking too much. Let me leave this up to you now to go through the details.
No problem. So doesn't it feel good to actually have a measure that was put by the government where we're like, it's almost too good to be true, right? Like you mentioned. Yeah. So that was my reaction. I was reading through the program and I was like, okay, there was probably something I didn't get out of this
Mhm.
essay. But anyhow, so like you so well mentioned, so if you have an individual that doesn't have their first house yet, and they may be considering, but even if they're not considering, like you mentioned,
Yeah, get it
things change,
started.
right? Things change, right? So the difference, and I like to compare this account to the regular TFSA, let's say it like that, because normally, even if you don't open a TFSA,
Mhm.
your annual contribution limit will accumulate over time. It doesn't change
Yeah.
anything that you don't actually have an account open. Whereas the first home saving account, you don't get that 8,000 limit as you see on the screen, unless you actually have the account
Okay.
open. So
And again, all you need is like $100 in there. Put something,
that's
a
it.
nominal
That's
amount, a
it.
couple $100, you're
Yep.
off to the races.
Yes, yes. And so the also the great advantage of this account is that when you contribute to it, you actually get a tax deduction, just like you would
Yeah.
when you contribute to an RSP, which is something we know with their TFSA, we don't get it. Yes, they tell us that if ever you make money out of your TFSA, it's not it's not taxable, but the contributions are not tax deductible. Whereas here it is.
Yeah.
What you need to remember is that over a lifetime, you're going to be able to contribute to this first home saving account up to a maximum of 40K. Let's say that you open it for your child and then they decide that they don't want to buy your house. The good thing is that you could actually take that, let's say 40K, 20K, 10K, whichever amount you would have contributed over the years. You could actually move it to your RSP or your RBIF, and you don't need contribution room. So this is great.
That's incredible. Like that's
It is
incredible.
incredible. Absolutely. It
By
is
the way, we
incredible.
should mention, some people may say, "Oh, but my kid, they're not making much income. Their tax rate's low." You can still carry forward the deduction as long as you want, and you take it in the year that it's going to benefit you the most.
Absolutely, absolutely. So I think it's very flexible. And one thing I'm gonna add, Paul, we know about the home buyer plan through the RSP, and one of the first questions that was asked by all the tax professional was, okay,
Mhm.
so with that program on, does it mean that somebody cannot use that first home buying plan that we have known about for years with regards to RSP? And the good news is that you could actually use both. So this is great. The only difference is that we know if you use the home buyer plan through the RSP, whatever amount you remove from your account, they expect you to repay it in your RSP, which is not a bad thing, as I like to say, because it's your money. It's going to serve you during retirement. Or if you decide that you don't want to repay it, it's okay, but you're gonna have to pay taxes on a ratio of 1 out of 15 every year until you repay your full balance. That's the only thing.
Yeah, this one's better. Let's go to the next slide here
Right?
so we make sure we get it in time. Let's move on to the next item. So, year-end strategies for seniors. Why don't we chat about this? We've used this in our practice before, by the way, this strategy, and it's got limited use, but nevertheless, it can save it be a big tax saver for the right individual. Why don't we chat about that first one there?
Absolutely. So for those individuals that are reaching age 71 in the year, but that who are still working. So this is really our target audience. We know that to be able to contribute to RSP, you need contribution rule. And your contribution rule is I'm sorry, is based on what we call earned income. Your earned
Yeah.
income will be based on, for example, for someone working, or your employment income. So let's say you have that individual that is working and that will have a significant income for this last year of 2024. We know that next year they would have had additional RSP contribution room. The problem is past 71, you cannot contribute to your RSP. So in order to save that last year, and some may think that does it really impact you, or does it really create a tax advantage? I'll tell you right away, it could. And we're going to see, and we're going to look at the specific example. If you want, Paul, we could actually jump to the example so that people really
Yeah,
understand what I'm
here.
talking about. Perfect.
Yeah, there we
So
go.
we have an individual who's age 71, who are either he's 71 or he will be by the end of the year, and he has earned income this year. So the 2024 earned income will be $150,000. Still significant. So based on the calculation provided for earned income, they will have from this income a created contribution room in 2025 of 27K, right? The problem is that they will not be able to contribute to their RSP because in 2025, they will be 71 years old. So what can we do to still benefit of that big $27,000? So Thomas can make his 2025 RRSP contribution in December 2024. That's very important because you do not want to miss that date. And as soon as you get to 2025, there's nothing else you could do. So what can he do? He will over contribute to his RRSP because with this example, we assume that he didn't have any other room, right? Any other contribution room. So he will over contribute by that $27,000 that he knows that would have been available in 2025 by doing that excess contribution. You have to know that for everybody, the first $2,000 of over contribution is not subject to a penalty. Anything above and over that $2,000 will be subject to a penalty of 1% per month. And this is per month until you actually withdraw the excess. Okay, so what's good about this strategy is that as soon as we hit January 1st, 2025, because he actually has earned income and therefore a contribution room of $27,000, his over contribution disappears. And therefore, what would happen for him? He would pay a penalty, but very insignificant, that will represent that 1 month at 1% and on $25,000, right? So it would be very less, while the tax saving associated to that $27,000 of RRSP contribution, assuming a marginal tax rate combined federal and provincial of 43.4, that would give him a tax saving of almost $12,000. This is really great.
This is great. I just want to mention everyone again, you're listening to Year-End Tax Planning Strategies webinar. My name is Paul Barreca at West End Wealth Planning. I am here. Our special guest is Guerlane Noël, and she's the Vice President of Tax and Estate Planning at Mackenzie Investments. And of course, those of you who'd like to ask a question, you can go to the Q&A box at the bottom. Don't go to the chat box, please. Go to the Q&A box. We'll try to get in the answers today. We're going to try to leave a bit of time at the end for Q&A. Where would you like me to go here, Guerlane?
Perfect.
Next slide.
Yes. All right. Let me go back to the last slide. I just want to make sure and not maybe two other strategies maybe that are worth mentioning. If ever you have an RSP and you were not quite ready to convert it to an RF, it could be good to create some pension income so that you could claim some tax credit, right? So for those people that may be related to this type of account, that could be good for you to know that if you have pension income, there are some tax credits that you could actually pay. Sometimes you could maybe convert only a portion of your fund. That could be, but you know that the only way you could start actually receiving an annuity is by converting your RSP to your RRIFs.
Not a huge tax saving, but hey, better than it with investors. How much is the tax saving on this, Guerlane? Do you happen to know? It's $200-300, I think, a year. Is that correct?
Exactly. It's really minimal.
Okay.
Right?
Okay. Now you've got at the bottom in here, apply for benefits, old age security. I don't want to spend a lot of time on that. That's a question we get a lot, by the way. When should I start this? And that's for another program. Again, there's a number of factors that we look at when we sit and discuss this with our clients, but we do see people making mistakes there. It's not uncommon, and more probably it will cost them money in their lifetime. But let's go on to the next item here if we can.
No problem.
All right, so we're going to pass by this and then here. Okay. A few other year-end strategies, and then we're going to start talking if you have a business or corporation. Because of the capital gains inclusion rate change, bigger impact on business owners than perhaps individuals. But let's deal with this here now.
Sure, no problem. There's also a strategy with RRSP. assuming that you still have, as an individual, a contribution room, we could use a tax income splitting opportunity by actually contributing to the RSP of a spouse. Just know here that the first thing you need to know is that to be able to use this strategy, you need to have space in your RSP in order to contribute to it,
Yeah.
right? Even it's not, if it's not your RSP, why do we place it in the income splitting opportunities? It's because whenever your spouse retires or start withdrawing income from her or his RSP, they will be the one paying taxes. So you have contributed, you got the tax saving, but the other spouse, whenever they're going to actually withdraw the amount, they will be taxed on the amount. So that's why we refer to this strategy as an income splitting tax strategy.
Yeah. Now, next thing, prescribed loans. This is something that when interest rates were very low a few years ago, this was a great strategy, worked incredibly well. Now, as rates have increased over the last few years, it's really, right now, I wouldn't recommend it.
Nope.
But again, in a few years, who knows? If interest rates drop, that's something. And this is a way to put money where if you have one spouse has a significant non-registered portfolio, they're paying the tax on all the realized gains, the dividends, the interest, whatever. And their spouse is in a very low tax bracket, but they don't have that large non-registered investments. Well, you can transfer the assets to the spouse so that they now pay tax on all of the income, dividends, realized gains, and interest, or so forth. Do you want to just go briefly through that, Guerlane? Then we'll move on to business owners.
Sure, and I think I will not retake what you said, Paul. That was great. But what people need to understand here is that what we're trying to avoid is what we call attribution rules. You've
Yeah.
talked about transferring one asset to the lower income spouse so that ultimately you pay less taxes in your household, but the law is well made again to make sure to avoid those transactions. And then even if you actually transfer the property, the income that is generated by the spouse that is purchasing that property will be attributed back to yourself, right? So in order to avoid this, you could actually create a loan that the law wants to be a real loan, basically where there is an interest rate that is at least equal or equivalent to the prescribed rate provided by the Canada Revenue Agency. And they actually want you or wants your spouse to actually pay the interest.
Yeah,
And they
you
give
have to
you
be
up to
paid. It
30
has to be
days.
paid.
Yep, 30 days after the beginning of next year. So that brings you to the end of January. If you haven't paid the interest rate, it doesn't work. The attribution rules will be applicable to the transferring spouse.
Yeah,
So
it's not
typically they'll use
uncommon. Excuse me, because we got a limited amount of time with Guerlaine. You want to be very careful about paying that interest on the loan. Again, this doesn't make sense now because the prescribed rate is, I think, what, 9%, 8%, Guerlaine?
Yes, about I don't
Way
know
too
for
high.
this trimester, but it's very high. It's not advantageous.
Not worth it right now.
No.
Let's just move on if we can, because again, we're starting to run. We've got some questions that I want to get to at the end. Again, if you have a question, go to the Q&A box at the bottom. Oh, wait a minute. Did I go back here? Anything, the home
Good.
buyers plan? We've talked about
Talked about
most
that.
of that already. Various
Absolutely.
tax credits, charitable giving, kind of a simple one there. If you're going to do that, do it before year's end. Let's move on. Now, this is something we deal with a lot of business owners, and especially now with the capital gains inclusion rate. Just quickly, if you are an individual, if you're declaring unrealized gains under $250,000, nothing's changed. And as a family, two spouses, you can get up to $500,000. So unless you're selling something significant, a business, a piece of property where you've owned for a while, that's where you want to be careful about doing this. Now, with a business owner, it's very different because the rules are that now the new inclusion rate, which is a 33% tax increase on your passive investment account, starts from $1. So a big tax increase if you have a corporate tax. And this makes a couple of other strategies even more applicable. A lot of people didn't realize that even prior to this change, putting your money into an RRSP or an individual pension plan actually, in most cases, meant you have more money in your pocket during retirement after tax than
Mhm.
in a passive corporate investment account. Well, these changes make the RSP or individual pension plan even more advantageous. And this is
Yeah,
where we're
wonderful.
talking about a lot of our clients. Should you be doing this instead of plowing that money into your corporate account? Again, the end game is how much do I have in my jeans when I retired, when I want to draw the income? But you have something about the reduction of the small business tax rate. Maybe you want to go over quickly,
Yeah,
Guerlane, about
sure.
that?
Sure. So for small businesses, I think one of the most advantageous incentives, I'm sorry, is the small business deduction. So
Yeah.
on your first $500,000 of taxable income, you actually get a very low rate. So depending on your province, you could get as low as 12 or 13%, depending on the province. So it's only on those first 500. And a couple of years ago, the government changed the rules so that they say, so for all those small businesses that are benefiting um, of those small rates, but are also keeping a certain amount of money in that we will consider as passive income. So here we're talking about your investment. There will be past a certain limit, which is actually $50,000, a reduction of your small business deduction. And when I say a reduction of your small business deduction, it's a reduction of the actual maximum of 500,000. So it's pretty harsh. So for every dollar of investment income that you earn above $50,000, which you will agree, Paul, is very low. It's not very hard to exceed. You get a reduction of the small business limit of $5.
Yeah.
So like if we do the math, once you reach $150,000, you don't have any room anymore, right?
And that's not indexed either, is it? That those limits
No,
aren't indexed. They're
no, it's been
static.
like that. Yes,
So in
it's
other words, it really means an effective tax increase every single year if you have one of these accounts.
that's what
So
it is. And with the new taxable capital gain inclusion rate that came in April, what people didn't realize is that it means that as part of what we call the adjusted aggregate investment income, which is really that limit that you're looking at for it between
mhm,
50K and 150K, because the inclusion rate is now 2/3 and not half, you actually get to that limit faster and quicker, right? So
yeah.
this will be something to think about, so that you don't get your small business limit reduced, to a minimum or to zero, even if you earn more than $150,000.
Yeah, so we recommend certainly of our clients, any business owners that have significant passive income accounts, this needs to be managed very, very carefully. And again, that's not uncommon. We meet business owners who don't have an RSP. They say, "No, I don't like RSPs. You have to pay tax
Mm-hmm.
later on. They're dumb," but they don't know the numbers. The
Mm-hmm.
numbers on the RSPs in the majority of circumstances, and now more majority of circumstances, I didn't say that right. The RSP is actually better. More money in your jeans after tax down the road. And that's really what it's all about. You need to talk to your advisor about that. Super important.
And Paul,
Anything
if
else
I
here?
can just, oh,
Pardon?
I'm sorry. Yes, I wanted to make just one last comment. If you are to be subject to this rule, that's where forcing the realization of capital losses could actually help you, right? To reduce your
Yeah. Good
adjusted
point. Great point.
aggregate investment income.
Okay, what else do we got here? Oh, I don't think we want to spend too much time on tax reporting. That's for your accountant to do. Just a couple things I just want to mention. We got a few questions here I want to get to,
Mhm.
but this to me, this whole thing of tax planning, as I mentioned at the beginning, this is a process that goes on. It's not a one-time event.
Mhm.
And I was reading some statistics from advisor.ca. Advisor.ca is an information service for advisors that's very reputable, brings us the latest and greatest information. According to them, 61% of all Canadians have a financial plan, which is bigger than I thought. However, however, of that 61%, 75%, their financial plan only deals with their investments. Doesn't talk about taxes, doesn't talk about estate planning, doesn't do retirement planning. And these are the key things. These are the key things. So you want to make sure your financial plan doesn't include all of these things. Does your advisor talk to you about all these tax information? By the way, a simple way to determine if you're getting that is, does your advisor ask for your tax returns every year? Do they ask for your insurance policies every year? Do they ask for your wills and powers of attorney? This is looking at the big picture. This is actually where the real money is saved, in my opinion. We're going to give people, we're going to go to a couple of questions now. Guerlane, we got
Sure.
7 or 8 minutes left.
Sure.
Anyone else who has a question, go to the Q&A box. We'll do our best to get to it. And then we're going to give people an opportunity. At the end, we're going to put up a QR code. If you want to chat with us about any of these situations, want to have a quick chat, we'll certainly give you that opportunity. First question here, Guerlane. How does the superficial loss work for stocks one has bought in less than 30 days before a sale where a loss occurred, when one sells all the stock and does not repurchase the same stock? Is that clear? I read that word for word.
Yes, yes, I think it's clear. The superficial loss here, if I'm understanding well what's being said, would not apply. Would not apply because there's no repurchase of either an identical or a similar stock. And that period would have been good. Let's say that in that same example, I think it was Brendil. Let's say that after 30 days or maybe 10 days after the sale, that same individual would purchase the same stock, then the superficial loss would apply, even if it was for a transaction that occurred before the actual sale. So it could apply, but in the way you phrase the example, it would not apply.
Okay, next is from an anonymous attendee, and I'm not 100% clear the question here. I'm going to read this exactly. What are the tax saving strategies related to RSP or RIF withdrawals if your fund balance is very high? So what I think the question is, if the fund balance is very high, the minimum amount of withdrawal from a RIF may be higher than what you need. I'm assuming that's the question.
That's
And
how I
really,
also.
that's really another avenue for long-term planning. In other words, sometimes we've done this with our clients, where the clients have a big RSP, and maybe in their early to mid 60s, and they're retiring. And normally, it'd say, well, let's draw income out from the investments that are taxed the least. Maybe they have a non-registered account. But sometimes we may say, your RSP is so big that when you reach age 72, you're going to be forced to take out so much that it's going to bump you into a bigger tax bracket. Maybe we should start taking some out now when we could take them out in a relatively lower income bracket and reduce the tax later on. Again, this is the massive benefit of long-term planning. And again, very key, if you have significant assets from various sources, you really need a detailed plan outlining what's the best way to sequence the returns out of the investment in the most tax efficient manner. We had an example we did with a client, and we showed them by resequencing when they drew money from their registered and non-registered, they were able to add, get this, $2 million after tax in their estate. That's big change. So again, this is the key of getting really good advice to sequence when is the most effective time to take those. So if you have non-registered accounts, registered, maybe you have money in a corporate account, maybe you have money from somewhere else, some real estate. You really need to sequence that in the most tax efficient way.
And Paul, maybe I can add to this. If the person is in a relationship with a common law partner or with a married spouse, and your spouse is younger than yourself, we always suggest them use the age of your younger spouse.
Excellent point.
So that your withdrawal are minimized.
Excellent. One more question from Gary. If you have no contribution room at the end of the year, you turn 71, could you over contribute 2K? At the end of the year, could you over contribute 2K? And that's the overage amount that you're allowed. You're not going to get a tax deduction on that. So I don't see any benefit. Why you're giving them $2,000 of after-tax money and then taking it back out and paying tax on it? No, You don't
Nope.
want to do that. Not a lot of money, but
Yeah.
you just throwing your money away for nothing.
On $2,000,
So
it's not worth.
yeah. So, okay, those are questions today. Listen, we're going to maybe start wrapping this up. If there's any more questions, we got a few more minutes. Please put them up. In the meantime, I wanted to put up, we have, and William, who is my associate, he is the one who's actually making all this happen today mechanically, because I don't know how to do it. So he's doing a great job. Thank you, William, for doing such a great job. He's going to put up a QR code now. And the QR code is, if you'd like to chat with us, anything that's come up, a short 15-minute call, any way that we might be able to help you out, simply take a scan the QR code, and you can set up an appointment at a time that's convenient for you. Got another question here. John, we've had questions from John before. I have an active small business that has no value for sale. We've got another minute or so. There is 2.5 million in retained earnings. My RSP is full. Should I set up an IPP? What is the advantages of an IPP? And I'll answer that. That really depends. It really depends. The advantage of an IPP is you can put in a fair bit more money than an RSP. And the other advantage is if you're bringing your family into your business, now you can, on your death, you can transfer that money to your kids if they're part of the business tax-free in their own IPP. It can be for people in the right circumstances. This is the key. You've got to spend a little bit of time with someone who knows what they're doing with IPPs. It can be a fantastic tax strategy for the right person and not a good strategy for the wrong person. So again, that's a very big question, but just in terms of the advantages of the IPP, it may or may not be advantageous for you, John. Again, if you want to scan the QR code at the end and chat with us, more than happy to review it with you then. Okay, 6:57. We want to make sure we're out of here in exactly an hour. I want to thank Guerlane Noël. You've been fantastic, Guerlane. Vice President, Tax and Estate Planning at Mackenzie Investments, for stepping in and putting on this very, very interesting presentation, loaded with great information to people on tax planning. Thank you so much. And again, remind everyone, tax planning is not a one-time event. It is a process that lasts, like anything, like you review your investments on a regular basis. You review tax planning, stuff changes, your situation changes. You want to always update what you're doing with your investments and your taxes and everything. So